You ended up having an interview with Meriwether, didn't you?
Absolutely, I did. Yes,
And was this an exciting thing? Were you wary of it?
because I didn't realize that I was being headhunted, as it were. It was all going well until we started talking about risk, and then it was clear we had different views about risk, and they were bankrupt, bankrupt, bankrupt.
So it seems to me like your relationship with Jim Simons is more of just he's an example of the best, and his track record is just such an inspirational run. Is am I getting that right?
Yes, I mean, what I've learned is that the numbers tell you the truth. People do like stories and characters. They like getting involved in behaviors of various types, but at the end of the day, it's the numbers. And I think that's very freeing because, everybody has the numbers. And if you start looking at them, you have an extraordinary filter. So you don't
Mhm.
waste time looking at hundreds of people who are not worth following. If you produce the numbers, you are exceptional.
Yeah.
And you need to know what those numbers are, and Jim Simons has them.
But I also believe that John Merriweather's numbers were the things that got everyone excited way back when, right? So when we're looking to invest like the best, what made everyone so interested in following John Merriweather as an example of someone bringing in amazing numbers? What was the legend that kind of backed him?
Well, he had a great background. He was the head of the prop desk at Salomons, very famous, the biggest trading firm in Wall Street, really. And he then set up the hedge fund, um, which attracted 1.3 billion straight out of the gate and grew to about 4 billion, maybe 5 billion in just a few years. And during those initial stages, his returns were exceptional. He also had Nobel Prize winning scientists working for him. It was just a great story. And for people who aren't necessarily discerning about how you look at results, that's all you need to know. And so that attracted more and more people, and it was an explosively successful hedge fund.
But even at that point, it was difficult to understand everything he was doing. You spoke a bit about not knowing exactly what his fund was back when there was an interview.
Yes, hedge funds don't have to publicly declare everything that they're doing. And if you're not a client, you may not have access to the information. You hear sort of with a delay how well it's doing, but it's harder to analyze unless they give you full access.
Back around this time, right at the height of long-term capital management, you were still working at JP Morgan as a managing director on the desk, and you were thinking about leaving the whole game and coming to America, doing your own thing. But before that happened, you ended up having an interview with Meriwether, didn't you?
Absolutely, I did. Yes, I was somewhat well known in London as a proprietary trader. I was managing director at JP Morgan's proprietary trading desk. And um, long-term capital management, John Meriwether's outfit, were a client of JP Morgan. So it was just natural for the head of the European desk to say, hey, we want to spend a day with you and see what you're doing and just have a chat about things. And so Victor Hagani came to JP Morgan and sat next to me for a whole day. And we talked and got on well. And I left it there and thinking that I was just entertaining a client, as it were. But then I got a call back from Victor Hagani inviting me over to Long-Term Capital's offices in Mayfair. So I said, yeah, sure, that sounds good. I'll see you whenever it is. And to my surprise, when I arrived there, he introduced me to John Meriwether right at the height of his fame and the height of his fund as well. So most people would have called him the master of the universe as when it came to trading and investment at that time. So things were going very well for him at that time when I met him.
So, when you first encountered him, how much did you know about his business at the time? And was this an exciting thing? Were you wary of it? What was the mood going into it?
Yes, I think I was unprepared because I didn't realize that I was being headhunted, as it were, to potentially be a partner in the world's biggest hedge fund. It's kind of a big deal. Um, and so I suddenly realized a few minutes into the interview with John Meriwether that that was why I was there. Uh, so so I was, adapting, but also enjoying a great conversation because it's an opportunity to talk to, one of the most famous investors around. And it was fascinating. It was how he does business, how I do business, and or JP Morgan does business. And obviously there were differences, but it was all going well until we started talking about risk, and then it was clear we had different views about risk. And I think the energy went out of our conversation, and they didn't pursue me after the after the interview, which I thought, well, maybe I could wasted an opportunity, but actually, as it turned out, it was a blessing that I didn't get invited to join them.
What made it a blessing?
Well, it turns out that yeah, they had $4 or $5 billion, but they had 125 billion in positions, so we're 30 times leveraged. So what that means is if you have a 3% adverse move in the value of your fund, you are basically insolvent. And they thought they had it all figured out with their Nobel Prize winning scientists and had a great run, felt that they were in control of the parameters. But that was 1997. In 1998, Russia defaulted, and the spreads on a lot of positions, some of which were theirs, blew out, and they were bankrupt. And they were so big that the whole market knew their position and didn't want to give them liquidity to get out. So the Federal Reserve had to step in, and the entire world's biggest hedge fund went completely bankrupt. So all those fantastic returns were lost, but also the original principal that people invested. So you go up 300%, and then you go down to negative 100%, because you weren't taking care of risk. And these are the smartest people, apparently, in Wall Street, who were basically endorsed with the money of all the most senior people in Wall Street. So that tells you something about how Wall Street works.
Right. So, in terms of looking for who the best investors are, John Meriwether quickly got struck off the list for you.
Absolutely. Yes.
So, going bankrupt is generally not a good sign of being a best investor. During the same time, while clearly the markets were going through a bit of a fluctuation, was there anyone that was making money? Was there anyone who was holding to best investor standards?
Yes. Best investor standards are, it's a very few number of people who have publicly available results which are best investor standards. We should be clear about that. But if you know what you're looking for, you can see there are always a few individuals who are doing something really quite extraordinary, but we need to know what extraordinary is. And Jim Simons had those numbers. And he had those numbers not just for a year or two, but for at least 3 decades. And to basically not lose money. I think there was one year when he lost like 5% right at the beginning when he was getting started up. But then he had no down years, in 30 years, and his compounding rate was something like 40% over, decade time periods. And that is what's ideal. You're not having to deal with the enormous problems of having huge swings in the value and really downswings really is the problem. And they were managing their money. So everyone, not only were you making a lot of money, but you were making it consistently and it was a smooth ride. To me, that's what a brilliant investor does. They turn the markets into an astonishingly consistent and compounding return. And Jim Simons did that in his team. And that was all system mathematical approach. Very, very successful and very impressive.
So this was called the Medallion Fund. And is this completely singular in history? Has anyone even come close to matching this?
There are a few, and certainly Paul Tudor Jones, Stan Druckenmiller are names that I think I quote in my book quite often.
Hmm.
And Stan Druckenmiller did 30 years without a single losing year, and I think he compounded at 30%. So there are some, but they are very few. But they're very golden, and you should find them and follow them and watch everything they do because this is mastery to me in investing.
And I suppose when you went independent from JP Morgan, you had the opportunity to just pursue mastery. So you were able to look up all of these greats and try and figure out how they worked. Was that the motivation for writing your book?
Yes, I mean, my motivation really was that I have so many conversations with people. I run a business, managing people's money, and there are some real kernels of truth about high quality investing, best investor standards, as I call them. And it's not obvious to most people what they are. But I think when you see it really creates a transformation in how people can safely outperform just about everybody else. So it's worth empowering people to to see how to do that.
And it seems pretty clear if there's more than one person who has done year-on-year compounding for over decades, that there is indeed a low-risk path to high returns.
There's no question. In fact, it is the ultimate way. And that's really why I wrote the book and used the best investors, because although they go about things in many different ways, the essential must have mathematics and approach is very much the same. So that kind of reinforced the idea that there is such a thing as best investor standards. But astonishingly to me, almost nobody seems to use it,
Hmm.
other than the most successful investors of all time. So I think we should spread the word.
Okay, spreading the word we shall.
Right.
I find it interesting that in a book about investing, you're beginning with a whole part, like a third of your book just on mindset.
Right.
What's the meaning behind that?
Well, I think this is the key part that just about everybody jumps over or misses. And I don't think people realize that if you do miss this, you will never get to the best investor standards. It's like you're going to need to have some basic understanding about behavior before you can really start, because you're going to have to come back to this behavioral component of investing all the time, reinforce it, improve on it. So you really can't do without it. And that's why I felt the whole part one of the book has to be on this, because it really is fundamental. People really need to have an investment objective and the right assessments and the right mindset and framework if they're going to be successful. And if you don't do this part, you're never going to be as good an investor as you could be.
And actually, just to quote Jim Simons to back up your point, if you
Right.
make money, you feel like a genius. If you lose, you're a dope. It's just too hard to do it that way. I have to do it mathematically.
Absolutely. Absolutely. He's learned that it's just easier and better.
So it seems like most of the ethos around Wall Street is kind of having a big ego and taking big bets and shooting for the sky. But all the best investors that you reference seem to take the completely opposite approach of just starting with humility. One of the quotes that, is one of my favorite to read uh, just because it's so out there is Ray Dalio's of
Right, right.
he began one of his books with a quote, "I'm just a dumb shit who doesn't know much relative to what I need to know." That's a pretty stunning statement to make given the success that he's had.
Yes, it really is, but I think it really speaks to right chapter one. I mean, it's the humility that is required. Obviously, if you're managing huge billions of dollars, when you do a trade, you've got to have very high conviction in that moment about what it is you're doing. You've done a lot of work and you're putting yourself at risk. But I think the secret to the best investors is they have very strong convictions lightly held.
Hmm.
So when you interview these people, they say, I'm absolutely convinced this is a good position, but I might change my idea and position tomorrow morning. You've got to have that flexibility and you've got to be ready to be wrong all the time,
Hmm.
all of them. And never have that big loss. They all reinforce that. Like several of the quotes in the book reinforce that.
Right. Yeah. I mean, there's Warren Buffett's teacher and mentor, Benjamin Graham, who says, right at this, you have this as the opener to chapter one. The investor's chief problem and his worst enemy is likely to be himself. In the end, how your investments behave is much less important than how you behave.
Absolutely right. I mean, it's so important. And even if you've been doing it for 40 years, like Ray Dalio, 50 years, you can never forget that. And it's not really about being right or wrong. It's about realizing that you will be wrong and making sure that when you are wrong, you get out. You have a
Hmm.
small loss. In fact, there's another quote by George Soros saying, it's not about being right or wrong. It's how much you gain when you're right and how much you lose when you're wrong.
Hmm.
So if you have ego in your trading and you really want to be right about your investment and you dig in with your position, even though you're losing money, that's not a behavior that's going to serve you well.
So the pattern between all of these best investors is that every single one of them seems to have independently arrived at the same conclusion, which is don't trust your judgment, be humble about your own abilities, and use a system.
Absolutely. And while we're quoting best investors, Martin Armstrong has been investing for 50 years and he's been developing an AI system since the 70s. And he says all the time, even now, 45 years later, he thinks very often his computer must be wrong. And he says every time he thinks his computer is wrong, he's wrong.
Hmm.
So he's learned to honor what his system says and how it does it. And it gets reinforced every day, every year, how important it is to have a system that works.
And I guess that's exactly why you wrote chapter two on the systems that we have in our brains and why we need to externalize those things. Uh,
Right.
you talk over and over again about Daniel Kahneman. Why is he the person that you most look up to in this behavioral systems perspective?
Well, I think in chapter one we've realized that there are many things that can go wrong with our own subjective thinking. Um, but how do we solve the problem? And the best um, analyst writer about this is Daniel Kahneman, who made several breakthroughs starting in the 1970s and 80s. He's a Nobel Prize winner, and he essentially um, proved that we're not rational. We are maybe predictably irrational. And that's not a very good makeup for systematic, repeatable, consistent trading over multiple decades. And so he had a model for how that is, and that was came from how our brain function is. He basically said we have systems, two brain systems that work together. The main one is very behavioral, reactive. It's making sure that we're going to be safe, um, and sometimes we need to react fast, and sometimes slowly, um, and it's really it's not thought that's driving our actions, but various behaviors. Yes. And that's a very sizable part of our thinking. Then we also have like a second system, which is our chess playing part. We can obviously think strategically and cleverly, but there's a limit to how much we can do compared to computers. Um, and also we get tired. That chess playing element of the brain does take energy. And so it's a limited function. So if we can engage with the system when we need to, but get the system to do the work, that takes the strain off. So that's one part of the system you need to have. But also you need to have a checklist to get rid of the behavioral elements. So if you're losing money on a position, you have to get out before the loss gets too big. That's just a must do. So you have to decide that in advance if your system's going to work. Certain behaviors you have to have a list, don't do. And that's like a number of professions, like surgeons have a checklist before they go into to do surgery. And it's the same
Right.
with investing. So yeah, so Daniel Kahneman showed us how to go from awareness to, and a mindset that is good for trading into a framework that we can adopt to start creating a system effectively.
It's interesting that you use the chess playing metaphor here, because one of the studies that I still find stunning to this day is the top chess players when they're actually playing for the award in the final tournament each year. They measured their metabolism and found that while they're playing chess, they have the same metabolism as marathon runners. So this is a lot of energy that it takes to use this system two of rational thinking.
Absolutely. Yeah,
And it seems that we need to use it selectively in order to use it just enough to create a system that can think for us when all we have energy for is our system one brain. Is that about right?
that's absolutely right. Yeah, and it's got to work every day, every part of every day, every week, every month, and consistently. We may have slept well last night, we may not have. We may have a cold. There may be interruptions. A system is reliably consistent in ways that it's hard for us to be.
And that's why Martin Armstrong trusts his computer. That's why Hedge trusts their system.
Yeah,
It seems to be
absolutely.
universal that the best investors have to have enough humility to realize that their systems are smarter than they are in the moment.
That's right. They're more reliable than they are and smarter than they are. Yes.
We've been talking a lot about how all the best investors rely on their systems, and in many cases, software. Is there a system that you could walk us through that we could easily understand just so that we can gauge what an investment system looks like?
Yes, we go into great detail on just such a system in chapter 3, using what we've learned from Daniel Kahneman. And really, the math of this system is probably middle school math. It really is that simple. Um, and we tested out on data for 40 years, so all kinds of different investment environments, uh, and um, and compare how we create the system, uh, made up of three key asset classes: stocks, bonds, and gold. And then we can print out the results for 40 years and see which systems did the best. And we can see that the three-way system, which we call it, outperformed equities, bonds, and gold over 40 years. And it did that with less losses and less volatility than the other three systems. And you can see from the 40-year period that any combination of a passive portfolio of equities, bonds, and gold would have underperformed the simple system over 40 years. So just by doing something very simple, we've actually proved that passive investing is suboptimal. Clearly so, with a remarkable simple structure. And that's really kind of huge. That's a huge breakthrough and proof of concept. So
Right.
this really establishes, the veracity of system investing. I mean, it's an astonishing result that could happen.
And what is the actual simple execution rule? Looking at the book, it says here that all you have to do is invest equally in whatever is going up, and whatever is going up is defined as the 3 month moving average being higher than the 10-month moving average.
That's right.
And
That's
that's
an
it.
uptrend. That's it. And if
So,
everyone can produce a 3 month and a 10-month moving average, yeah.
yeah, I mean, that is basic arithmetic in comparing two numbers.
That's right. And so you only put the three at which of the three assets are in an uptrend into the portfolio, and you put them in equally if they're in an uptrend, and you
Mhm.
rebalance once a month. It takes you like 5 minutes. So
So
it's that simple.
So why wouldn't I guess part of the difficulty is that when you understand how simple this is and you could just see the graph of the result comparison,
Right.
why
Yeah.
would anyone do passive allocation? Would they just not, is it just because they're not aware that this is a possibility?
I think that's the case. Uh, but you have to ask why, since it's so simple. And it's just not the way that asset managers tend to work. They tend not to want, historically at least, they tend not to want to do many trades because it used to be expensive. There'd be brokerage or something. Today, that's really not true anymore. So that's no longer an excuse. Um, in Very often, asset managers want their clients to be fully invested so they can charge fees. But even there, I think you can be fully invested. You just have to do this. I think it's really neglect because they haven't don't aren't using the best investor standards. They haven't figured out what is best investing, what is your investment objective, and how do you assess it. That's really very vague. And to me, that's unacceptable because if you're not crystal clear about your investment objective and assessments, then there's some vagueness in your investing. And that vagueness essentially means you're gambling to some degree
Hmm.
rather investing. The great thing about the best investor standards is that everything has a rule and you can categorically, objectively say, are you compounding and how well are you compounding? And that answers a lot of the questions about how are you doing? Because compounding means that actually you're making money, first of all. And secondly, you know the rate at which you're making money for the long term. And that's really should be the objective and assessments that everybody has. But ask Wall Street why they don't do it that way. I can't get a good answer.
I mean, there's likely incentives pointing them in all sorts of different directions, but we probably don't need to go into it too deeply right now. Instead, I think it's important to make sure that we take the right lessons away from this three-way system that we just went over.
That's right.
Basically, we have now a floor that gets you kind of into the doorway of what compounding can look like, even at a really simple execution level. And then
Yes.
obviously at the upper end, you've got someone like Jim Simons with the Medallion Fund over multiple decades. Obviously, this works and there are levels to this thing. But very
Yes.
importantly, because you can easily understand the baseline entry point into this, if you really understand this as a client to an advisor, you should be able to then demand that whatever advisor you have at least do this and at least compare favorably to it, right? That seems like a very empowering message.
Absolutely, it is because you get complete control over your money and your future by doing so. And you're taking out the guesswork. You have complete clarity over what the objective is. As you'll find out later in the book, you'll also have all the metrics, which will make that very clear. And you can tell in real time. You don't have to wait to hear from your investment advisor about how you're doing. Any day, you can go in and you can check how exactly you are doing. And you're going to know what to look for, and it's probably going to take you 5 seconds to figure that out. So this is enormously empowering and puts investors on a completely different track than the track they're typically on with most investment advisors.
So we now have a set of role models to analyze what they do. We have a very simple breakdown of what a compounding structure in a system looks like over time. Maybe we can return now to the long-term capital management situation where they were making, 100% year on year and then went bankrupt. Knowing what we do now, what happened there? What were the disasters that people might be able to avoid or at least be aware of in the future?
Well, there are many, and chapter 4 is all about long-term capital management because there's so many lessons to learn, and we won't be able to cover them all. But I think um, one of the key issues is that people default into only looking at return when they start investing. And it's very easy to understand why behaviorally. I mean, if you that's what you want the return. How are you doing? One measure, easy measure is return. And you can think that's all you need. But if you do, it's very clear since the data going back to the Second World War, you're going to do suboptimally because return is actually, strangely, it's a bad um, investment objective, and it sets off bad behaviors, and it's not a good assessment at all about how you're doing. It doesn't measure skill, it doesn't measure risk, and it's a backward looking statistic. So it doesn't really tell you much about, just because you've made 100% doesn't mean you're going to make 100% next year. So in
Mhm.
fact, it could quite easily represent the fact you're taking way too much risk and you were lucky.
Mm.
And clearly, the bottom line with long-term capital management is they were taking way too much risk and had a good run. And it, because people again are looking for returns, they're going to be attracted like a moth to the light when they see something with a great story, great personnel, characters, Nobel Prize winning scientists, high returns. Most people are going to stop their due diligence right there, say, okay, here's my money. Big mistake.
Mhm.
And what we're going to do in this book is show you why and what you're looking for and how to monitor what you're doing. So you absolutely know any day what's going on and whether you should be in this fund or not.
Mhm.
And certainly very high risk is a red flag unless there's extremely good risk management involved. So that's the big one. People fall too easily into to investing in funds which have had a good track record, high returns. Yeah, that can be good, but
Mhm.
it's far from being the only criteria you should look at, and it can be actually a red flag.
And specifically, when we're talking about returns here, you're talking about quarterly returns, annual returns. Whereas if you're looking at other metrics that indicate risk management, that means that the returns are more likely to have been acquired through skillful investing, which would then survive over the long term many years.
Yes, yes. I mean, I think certainly there usually should be measures of the return you're getting for the risk that you're taking.
Mhm.
And certainly you should look at that if you're looking at a fund, because then that takes out the lucky with high risk element, which is dangerous. Um,
Mhm.
so if there's an indication, there are many indicators like Sortino ratio, Sharpe ratio, various others. I like the Kalmar ratio. Um, so you should be able to get those numbers, and that should be a help. But actually, we're going to show you, precisely the the most important factors and the priority of those factors.
Mhm.
Because if you have a trading system, it's not a, well, we'd like to have these five things kind of thing. You've got to be clear what's priority number one, priority number two, priority number three. So you'll have a complete ability to do this analysis yourself. It's not that difficult. And if you have a good broker, all those numbers should already be available to you.
Okay, so then basically we've covered part one of the book. The whole point is that your investment mindset is the foundation of everything else. Without it, you've just completely you will be blown by the wind wherever the markets flow. And in part two, we're going to go start getting into everyone's favorite topic, the math. It's at least your favorite topic, but that's why you're an investor. Um, and uh, hopefully this will be more of an empowering lesson because we've explained the intro. We've explained why these systems work over time, why they're important, and why they outcompete everything else. Are there any closing notes that you'd like to leave us with on mindset before we close out this conversation?
Oh, yes, it's a very big subject that we've covered in a short period of time, and hopefully we've given a clear narrative through it. But there's nothing like going deeper into these points because you really need to have them reinforced all the time, even if you've been doing this for 40 years like I have. Um, but yes, it's the essential groundwork for everything that follows. And the but now we have to get more deeply into the math. How do we take that simple three-way system that could become Jim Simon's
Hmm.
and do something like that for ourselves? What actually works? Why does it work? And what it reveals is that the central assumption of most conventional asset managers is plain wrong,
Hmm.
which is why they don't follow the compounding. And this isn't bad news for you, it's really good news because what it means is once you adopt the right approach, not only can you make higher returns, but you can make them with lower risk. That really is achievable. To put those two things together, Wall Street would say that's impossible because their base assumption is if you want higher return, you have to take higher risk. That's wrong and it's dangerous. So we're going to find out why that is. And it's so empowering as to be remarkably essential if you're going to be successful. So it's the essential math. We're going to make it easy, but it's another really important step.
Well, thank you so much for covering this. And for everyone at home, we only just scratched the surface of part one. If you really want to study all of it, the books are still for sale. You can buy one. And if you read along, we'll be covering the next two parts in our next two videos. Thank you for watching.